to be with you on today. This is an exciting opportunity. If you're just joining me, drop where you're watching from in the chat. I want to see who is here today. We're going to be here for just a little bit, and I'm going to stay on one topic because I really want to do a deep dive so that you get everything you're going to need, because today's topic is one that trips up almost everybody that I have come in contact with in this space, even people who are doing everything right. Let me ask you a question. Have you ever gotten a raise, closed a bigger deal, or grown your revenue, and 6 months later, you still feel just as tight as before? That's not bad luck. That's the system doing exactly what it's designed to do. I stay on top of how credit, banking, business cash flow, and financial reporting connect to each other. And in every single case I look at, the pattern is the same. People increase their income. The system increases its grip on that income right along with it. So today, I'm going to show you exactly what turns more income into real wealth, and not what just turns it into more bills with better handwriting. We're going to break down what captures your income the moment it lands. Then I'll show you the 3 signs that tell your money it's actually building strength. We'll go through what not to mistake for wealth, because some of it looks very, very convincing. And because we're live, I'm going to open it up for your questions in the middle so we get them and we're able to address them effectively. The real issue today isn't how much money is coming in. It's what that money is positioned to do the second it arrives. Here's the frame for these next several minutes. What makes income become wealth? Not a full financial plan, not a get-rich-quick promise, just the real mechanism behind why some people's money grows stronger over time and other people's money, well, it just goes around and around faster in a circle. Income is money coming in. Wealth is what stays, what grows, what protects you, what gives you more control. And here's the trap most people fall into. They think the goal is simply earn more. So they focus on everything and they look at the top line: more clients, more hours, more revenue, a bigger salary. And then they're confused when none of it seems to change their real position. The truth of the matter is, earning more is only half of the equation. What that money does after it lands is the other half. And most people never get taught that second half. That's what we're going to fix right here today. Wealth is a position. Let's get specific, because I want you walking away from this with something you can actually use, not just a nice sounding idea. Income is a flow. Money enters, money leaves. The cycle starts again the next pay period, next invoice, next sales month. Wealth is different. Wealth is a position. It means you have more control, less financial pressure. You own something that can support your future, and you have more choices when life or the system changes on you. Here's a simple example. 2 people both get a raise this year. Same amount, same timing. Person 1 takes that raise and reduces financial drag. So they pay down a high interest balance, it builds a reserve, restructures something that was costing them every month. Person 2, however, takes the same raise and upgrades their lifestyle to match it. Bigger payment, bigger subscription, stack, bigger obligations. Same income increase, 2 completely different positions 6 months from now. That's the part almost nobody explains to you. More money does not automatically mean more strength. Sometimes it just means the system has more to work with. First, let's talk about the real problem, because before we talk about what builds wealth, you need to see exactly how income gets captured before it ever gets the chance. Let's look at it. So how do you actually stop this from happening? The system capturing your income, your next dollar. Here's the exact system. Write this down if you need to, because it's very important. Step one, before you spend $1 of new income, list every recurring charge, pulling money out of your account each month. Every recurring charge, subscriptions, high interest balances, fees, anything automatic. Take you about 10 minutes. Do it on your phone right now if you have to. Step two, look at that last list and find the highest interest rate or highest fee, not the biggest balance, the highest rate. That's the one bleeding you the fastest, and it's usually not the one you guess. Step three, every time new income shows up, a raise, a new client, extra revenue, split it 50-50. 50% goes straight at that one highest rate item, not spread across 5 things, one target, until it's gone. Then move to the next highest rate. Step 4, the other 50% goes into a separate account you do not touch. Not your checking account, a separate account. I call this the account for stability. This is the beginning of ownership. We'll come back to that in a minute. The boundary. This is for new income only. A raise, a bonus, new revenue. Do not try to force this system out of the money you're already using to survive, especially if you have nothing seemingly left over and you're already stretched. That's not what it's for. And for trying will just create more stress, so don't do it. That's the mechanism. That's how income stops leaking and starts building. Now, some people are in a different position, and I recently did a video sharing with you how you can do this with 4 steps with every paycheck. But this is for someone who really wants to attack something and it seems like it's very, very tight. Everything else today is what to check to make sure it's working. Now, here's why this works and why most people never think to do it. Interest reaches into your future. High interest doesn't just cost you money today. It reaches forward and claims part of your future income before you earn it. That's exactly why step 2 matters. The highest rate is charging you rent on old decisions every single month. I want you to hear that. The highest interest rate you've got right now is charging you rent on an old decision, but you're paying it every single month. Whether you send it money or not, killing the rate, not just the balance, is what stops the bleeding. Why a payment alone isn't enough. A payment can feel like progress while your cash flow stays trapped. Paying down debt, this is a very good thing. I'm not telling you to stop, but a lower balance alone doesn't create a stronger position if you still have zero room to save or handle a surprise. That's why step 4 exists. The 50% going into a separate account is what actually builds your position, while the other 50% kills the drag. Do both every single time. And you're not just paying, you're building. I got to say that again. Reducing a number is not the same as building strength. You need both halves. Now, why business revenue isn't automatically owner's wealth? Same rule applies in your business. A business can produce more revenue while the owner still has weak cash flow and zero stronger position. If you're a business owner, run this exact 50-50 split on your owner draw or profit distribution, not just your personal paycheck. Half kills your highest rate business debt. Half goes into a business reserve account you don't touch. Because the truth of the matter is the system doesn't measure how hard you worked. It measures the position your money creates. This system is how you take control of that position, starting with your very next dollar. Now, I want you to do something real quick in the chat. Tell me your highest interest rate right now, not your highest or biggest balance, your highest rate. If you don't know it off the top of your head, that's exactly the gap this system just closed for you. Now, there's 3 signs your system is working. We've got to know the mechanism, and we've got that down. Here's how to check if it's actually working. Sign 1, less drag, and how you measure it. Financial drag is anything pulling you backward every month. High interest, fees, poor structure, unplanned pressure. Here's how you measure it. Take your total monthly debt payments and interest charges today, write the number down, then check it again in 90 days after running the 50-50 split. If that number is dropping, the system is working. If it's flat or rising, you've got a new debt outpacing your redirect. Go back to step 3 and increase your percentage on the debt side until it moves. Sign 2, ownership, and how to start it with $0 in the bank. Wealth starts forming when your income helps you own something, not just pay for something. You don't need a large amount to start. The separate account from step 4, even $50 a month, is the start of ownership. The mechanism isn't the amount, it's the habit of every single income increase touching that account before it touches your lifestyle. That habit is what compounds, not the starting number. Sign 3, more options and how you test for it. Future options mean you can handle a problem. Say no to bad deal or fund an opportunity without panicking. This is important. Here's your test. Could you cover a $1,200 surprise expense today without touching a credit card? If yes, your system is producing options. If no, that's your next 50-50 target. Build that number in your separate account before you increase anything else. This is your stability. Run your income through all 3 every time. Did it reduce drag, start ownership, or create an option? That's the full loop. Now, I want you to do me a favor. Could you cover that $1,200 surprise today? Yes or no? Put that down right now. Let me know. I want to see where you are actually at this very time. Now, what not to do with this system? Here's exactly what not to do, because the boundaries matter as much as the steps. Don't run the 50-50 split on money you need for bills already due this month. That's not new income, that's obligated income, and forcing the system there just creates missed payments and worse situations for you in the future. Don't stop at killing debt and skip the separate account. That's only half the mechanism, and it's why a lot of people pay off a card and still feel stuck a year later. Don't treat a high credit limit as if it's the separate account. A limit is access, not ownership. Credit isn't just about borrowing money. It's about positioning yourself for opportunity. That's leverage. And access alone isn't a position. Don't assume business revenue looks like owner wealth. Run the split on your actual draw, not your top line sales number. Don't wait for the big enough income jump to start. The habit at $50 is what builds the muscle for when the number gets bigger. I'm going to say it again. Income is not wealth just because the number is bigger. The system I gave you today is what turns the number into a position. And skipping any one of those 4 steps is how people miss it. Now, I want you to do me a favor right now. Let's take a few live questions before we move into the next part. If you've got some questions, I've been given some, and this is very, very good that I want to use. Thank you for those who have sent these in while we were going on. And I see a couple things that are very, very good. So let's look at the first one here. What if my income went up, but I still feel broke? That's the whole video right there. Income going up doesn't mean your position changed. Run the 3 signs I gave you today. If your drag number hasn't moved and you haven't started the separate account, the raise got absorbed by the system before it reached you. That's not a discipline problem. That's a positioning problem. Let's see. Question number 2. I have multiple debts. Which one do I hit first with the 50%? Great question. This is what you do. Highest interest rate, not highest balance. I said this in section 2 for a reason. The rate is what reaching into your future income every month, and it is hurting you. Kill the rate first, then move to the next highest. Balance size doesn't matter for the order. It's highest interest rate debt first, then move to the next one. 3, does this work if I'm self-employed and my income isn't steady? Love the question. Yes. Actually, this matters more for you. Every time revenue comes in, run the split on what you actually pay yourself, not your top line sales. That's the business owner point from section 2. Inconsistent income makes the habit more important, not less. We've had some good questions, and we're going to keep moving because I want to connect all of this to the bigger picture before we wrap up. So I want you to look at this, the CBL lens, credit, business, life. This is where the CBL Wealth Blueprint comes into play. We talk about it all the time on the channel. Credit, business, life. Credit affects the cost of access. It affects the terms you get offered. It affects the options available to you. And it affects how the system reads your entire financial position before it ever makes you an offer. Business can create cash flow, but the business has to do more than just produce revenue. It has to actually help create owner strength, not just owner activity. Life matters too, because life determines whether a new income increase creates freedom or just more pressure. If every raise creates a bigger lifestyle burden, the money isn't improving your position, it's just relocating the pressure. Credit can create access. Business can create cash flow. Life determines whether the money creates freedom or more pressure. All 3 layers have to work together or the whole thing leaks. Today, I'm showing you what to look for. The specific answer for your situation depends on which of these 3 layers is creating the most friction right now, and that's different for almost every person watching this video. Now, I want you to do something. Quick gut check before we move into the last part of this video today. In the chat, tell me, is your biggest friction point credit, business, or life right now? Just drop the one word. I want to see the pattern in the room on today, because it really matters that you understand, are we really facing a credit challenge, a business challenge, or a life challenge? Either way, if all 3 are not harmonizing in your life, you will not see the success you could see. So let's get a clarity moment. Maybe the problem has never been that you weren't working hard enough. Maybe the problem was that your income was entering a system that had already decided where it was going to go. Once you see that, the goal changes. You stop asking only, how can I earn more? You also start asking, what position is this money creating? The real lesson is this: more income only helps you when it's positioned to create more control. That's the entire difference between money that just passes through your hands and money that starts building your future. Now, you've probably been told your problem is discipline, budgeting. You may be telling yourself simply working harder would be a better thing for me. Those things may matter, but they may not be the root problem. The deeper issue may be a financial system you have not been shown how to see yet. So I built a free tool that helps you identify which layer is creating the most friction, and you can find out in about 5 minutes. It's called the CBL Financial Positioning Diagnostic. The link is in the description for this live and my videos. No cost. I said no cost. No pressure. But man, you get a lot of clarity if you take that diagnostic. You can do it. It only takes about 5 minutes, and you're going to be so glad if you do. Now, the free diagnostic helps you see exactly where the friction may be sitting. But seeing the problem is not the same thing as building the full solution. If you want help connecting credit, business, and life around your actual position, that's what the CBL Wealth Blueprint is built to do. It moves you from scattered financial actions into a clear system built around your specific situation. Because everybody watching today does not have the same problem. Some of you have a credit issue. Some of you have a cash flow issue. Some have a business structure issue. Some of you have plenty of money coming in, but no clear place for that money to actually build strength. The first step is knowing which layer is creating the most friction for you specifically. Then you build from that right position, not a guess. Now, let's take a couple more questions that my team has gathered from people who are getting this great opportunity, and we're going to answer those for you on today. Number one, how much should be in my separate account before I feel safe? Listen, use the option test from Sign 3. Could you cover a $1,200 surprise without a credit card? That's your first target, not some big scary number. Once you clear that, you've created a real option, and that's the ownership piece compounding. Next question. What is my employer bank? What if my employer or my bank raises my limit instead of my pay? Is that the same thing? Great question. No. And this is exactly the trap in the why not section. A higher limit is access, but it's not a position. The system doesn't care what you're approved for. It cares what you actually owned. So don't let a limit increase feel like progress if the drag number hasn't moved. Listen, people, your credit limit should not be a part of your budget. It is what you use for leverage, not your budget. Next question. I paid off a credit card last year and still feel stuck. Why? Because you did half the mechanism. You killed the drag, but if the other 50% never went into a separate account, you never started ownership. That's Sign 1 working while Sign 2 sat at 0. Both halves every time. That's the rule. So you get some extra money, hit that high interest rate, but make sure you put the other 50% in that account that's going to give you stability so that you know if an emergency or life happens, you've got it covered. Next question. Is this different from just budgeting? Good question. Well, budgeting tells you where money goes. This tells you where money should go the moment it increases before it hits your normal spending pattern at all. It's a redirect on the front end, not a review on the back end. That's the mechanism difference. And that's a very important question. And I appreciate that being asked. Next question. How long before I actually feel a difference? Check your drag number in 90 days. Because listen, 90 days is important in everything relative to credit because it gives you the opportunity to do a reset. It's also the opportunity for a reset in finance. I said this in section 3. That's not a promise of some magic number. It's a checkpoint. If it's moving, the system is working. If it's flat, you go back and increase your percentage on the debt side until it does. Listen, do me a favor real quick and subscribe to this great channel. Hit the like button because we want a lot of people to see this so they can be on top of this information just like you are right now. Drop a comment below. Let me know. Is your biggest problem that income disappears, debt stays high, or your money just doesn't create more options? Your answer helps me build the next video around exactly what people are facing right now. So please be honest with me. I want you to get this today. I want you to understand this because it's critical and of great importance that you understand more income with more bills will not increase your wealth. So you've got to make a decision. I've got to introduce something into the system I've been running. And today I'm telling you to introduce the 50-50 split. It is going to change your position. And I guarantee it. Do it and watch in 90 days review to see exactly the change that has been made. Here's what I want you to remember from today. Income is a flow. Wealth is a position. Build the position and the money can begin to work differently for you. I want to thank you so much for being here with me on today. I see every one of you that comes in and watch and leave comments, and I appreciate you for showing up. I want you to be blessed. I want you to have an absolutely awesome rest of the day and a great rest of this week. And I look forward to seeing you again real soon.